Mortgages. There are three types of mortgages. There's traditional financing or bank money, there's hard money, and there is private money. All three of these are very important in your real estate investing career. Bank money or traditional financing. So this is a type of mortgage most people are familiar with. You want to buy a house, you go to the bank says, hey, I want to appraise the house and I'm going to give you, based on your credit score and your income and this great big application that you have to fill out, a 10003 or 1003 form, a loan based on your credit and income. And if you're buying an investment property, it won't be the interest rate will not be as good as your primary home. So if you were not aware of that, please be aware that interest rate will be higher because it is an investment home. And you will have to put more money down, most likely 20 to 25%. And depending on your situation, you may have to put down more. Now, with bank financing, let's say they're going to give you 80% financing. You want to buy a $100,000 house. They will give you 80% of what your purchase price is if it appraises. So that property, if it's a $100,000 property, has to appraise at $100,000. What if the property, because you're such a great real estate investor, appraises for $120,000? First off, it's likely not to happen because appraisers are not going to appraise it for 120, but sometimes it does. Sometimes it appraises for a little bit more, sometimes 10,000 more. But let's say it did 120,000. Wouldn't you think that you would be able to get 80% of the $120,000? No, they don't let you do that. They give you 80% of the purchase price and it's the lesser, or the appraisal value, but never more if the appraised value is more. So you do not benefit from buying the property right. You do not benefit for it appraising over. So ultimately, if you're going to buy a property for $100,000 and get an 80% mortgage and put 20% down, that's the best you're going to get. You're going to have to put the 20% down and pay the bank fees. Some of the advantages of working with banks, though, however, especially local banks, is, one, with local banks, you can build a relationship and they may lend you more than a traditional bank, not loan to value percentages, but they may give you more loans because you're also limited in the amount of loans that you can get from a bank, which I will get into. But some of the advantages are the interest rate with a traditional bank is lower than if you were going to go private money or hard money. And also they will give you 30-year mortgages. When you get into private money and hard money, these are usually shorter term loans, sometimes interest only, et cetera, et cetera. So that is bank financing. Hard money. A lot of people, it's such a cool name. Everybody heard hard money, maybe you didn't hear hard money. Hard money means basically non-bank financing, and it's usually used to give somebody a bridge to bank financing or to flip. So a hard money lender they could be private or they could be a bank. They would be somebody that's charging higher interest rates and higher points. And a point is 1% of a loan. So if it's $100,000, 1 point is 1%. So a hard money lender will lend to people with less than better credit and based on the property, not the person. So they're very good for people that are getting into real estate, don't have good credit, don't have a lot of capital, and they will also let you benefit from buying right. So a hard money lender is a private lender, could be a bank, could be a person that will charge higher interest rates and higher points, what will be easier for you to get loans and will not, for the most part, won't limit the amount of loans you can get. Private money. Private money means, your Uncle John is lending you money. Maybe it's not your uncle. That's a bad example. Your uncle could lend you money, though, and it could be collateralized with a mortgage and a note. So private money are basically private investors, not banks, that are going to loan you money to buy a property. So on the other side of real estate is also private lending. So some people buy houses, some people loan money to buy houses. And those people that loan money will also charge a higher interest rate than traditional banks and they will also charge more points than a traditional bank, generally speaking. Generally, the loans for hard money or for private loans and hard money loans are shorter in term. You're not going to get a 30-year private loan. It's possible because they can do whatever they want, but most of them are going to be 5 years, 2 years, 3 years, etc. So usually shorter in term, higher in cost, higher in interest rate, but super easy because if you meet Phil on the street and Phil's interested in making 10% on his money, you can have him lend you money, wire to a title company, and he's now your private lender.